Would you like to join us for 3 interesting webinars this Saturday? Let's look at what we have in store for you. At 10 a.m., we have a webinar that will discuss the importance of SIPs and lump sums in your investing journey to acquire your dream house. If you are dreaming of buying your own property, this webinar is definitely for you. Don't forget to register. At 11 a.m., we have a webinar on how a true active strategy can unlock potential in India's large cap space. Register using the link in the description. And finally, at 12 p.m., we have a webinar that will explore the tax dimension of multi-asset investing, which will take into account the updates from the budget as well. We hope you can make the most of it and also hope to see you all there.
To sip or not to sip? This is a running controversy in the recent days. Let me jog my memory and tell you what I have seen in SIPs. In every bull market, at the peak of the bull market, I would always look at where the SIPs are going because it tells you whether people are conservative in their investing, whether they are correct in their choices, and whether those choices will survive the next bear market. Here's the shocker. In every bull market, I would see that a very high component of the SIPs were going into the overvalued parts of the market. Incremental SIPs had a very high share in these overvalued parts of the market. Go back to 2018 when the small cap boom was at its peak. SIPs were running very heavily in small caps. Go to 2008 and you will see SIPs in power and infra related themes. Go back to 2000 and you will see the SIPs were in tech. So people always chase performance through a SIP. Now here's the problem. When performance is already in the price, if you are going to continuously do your SIP as the price keeps coming down, what is the chance that performance will come back and reward you for doing that SIP? Experience has a very clear answer. You are the fall guy. Now, is this a problem connected to the methodology of SIP or how an investor adapts the instrument of SIP? I think it's the latter. Now, in 2024, we know that a significantly higher parts of the SIP went to small and mid cap funds. It's no royal secret. I wish that we had more transparency and breakup in the public domain and highlighting of this data. Then more people will understand the problem. Clearly, large cap funds were not receiving the same kind of SIP patronage as say a small cap or a mid cap fund. Now, you can argue that investors are hugely impressed by the potential of these two spaces, but I am not buying that. According to me, investors were clearly chasing performance. And today, barely 40 days into the new calendar year, what looked like a very promising year to begin with has turned upside down. Now, this is what has made a lot of people livid and angry. But when we are invested in the wrong place, when we put our money in the wrong place month after month, then we are setting ourselves up for a problem. And when that problem blows out like it's doing now, then we tend to become angry. But anger is not the answer. We need to learn from the problem, get out of the problem, and get on to something which is more sensible. Being angry is not going to help. Clearly, whenever SIPs chase performance, they lose the scope to succeed. When performance is at its peak, if you are going to chase that performance with a SIP, you are going to invest capital month after month in the wrong place. Now, this problem has only one solution. The investor must take more responsibility. He must know when he is chasing performance and when he is chasing opportunity. The two are not the same. And whenever he is very cognizant of this, he will always do his SIP in a correct place. If you are being very realistic and risk centric in your decision making in a SIP, the SIP will be a very strong and successful investment instrument for you. Only then will your process of investing every month turn out true to the slogan mutual fund sahi hai. But if you are being greedy and if you are going and investing in all the wrong places, then it's not going to be a happy ending. Clearly, investors in the recent years have been chasing performance through a SIP, and everybody thinks that doing a SIP is very easy. Yes, transactionally it is very easy, but in terms of decision making and choices, it is not so easy. It is definitely not simple because you may need to walk away from a product which is first quartile and showing very high performance to buy another product which has potential, but that potential is yet to be visible to you. So, investing in the right place would mean looking for places where potential is yet to play out, and doing it through a SIP can actually give you tremendous peace of mind and desired investment outcomes. The problem is not with the SIP, the problem is with how we SIP, where we SIP, and also when we should stop a SIP. Knowing that is very critical. If you are going to stop a SIP, it doesn't mean that you are going to stop sipping. You are going to stop doing a SIP in a particular place and you are going to start doing it in another safer place. Asking you to do that is in no way something you should object to. In fact, it should be something you welcome because it's an alert to you to move to safety, to seek performance in a safer place. After all, investing your savings month after month should give you the desired outcome after a few years. It should never be the case that you've done a few years, lost faith and taken your money out after making a loss. Clearly, the power and potential of a good investment process and an easy way to invest like the SIP will need to deliver for you, and for it to deliver for you, where you do your SIP is important and how you do your SIP is critical. Do remember this when you review your SIPs and make sure that your SIPs go on but in the right place. Thank you for watching this video.